Hello everyone, I'm going to teach equity market. So basically, mm, basically, equity market is a part of capital market. Capital market basically means securities market, which have a maturity of more than 1 year, and they can be of two types: equity or debt market. Both equity and debt market have two subsets. They are primary and secondary market. And so, in this video, I will be teaching about equity market. Now, few of the basic features of equity market are: in equity market, when a company lists themselves, then their dilution of control occurs because each shareholder gets a voting right. That's why the control gets divided into each shareholder. And also, regular dividends are paid to each shareholder, but also the dividends are not fixed and it varies on the basis of the profit. So they are variable, the returns are variable, and voting rights are given to the shareholders. And due to this variability in profit, the risk in equity market is higher. And also, it is good for making long term money and not that good for making short term. And there can be two kind of shareholders: inside and outside shareholders. Inside shareholders mean people who are working in day-to-day activities of the company, and outside shareholders who are not related to the company directly and they have just bought the shares of the company. So these are the basic features. Now we will look at some important terms for this chapter. First is pricing of shares. This means the cost to buy one share. Second is face value or par value. This is the value, this is actually the original cost of share. Like for example, if your company is listed in primary market at first, then at the starting, if it is listed for 100 rupees, then this is called the par value. But after a few years, if uh, like due to demand in public, if its price goes to 120, your dividend won't be paid as a percentage of that current price, but it will be paid as a percentage of this par value, which was 100 initially. So this is basically used to pay dividends. Then issue price is basically the price in which shares are issued to the general public in the primary market. uh, Current market price, this is the market price at which the shares are currently traded in the secondary market. Okay. So shares can be of six types: equity share, preference share, bonus share, right share, private placement, and ESOPs. So first is equity share. In equity share, the dividend is not fixed and it is based on the profit of the company. And the people who have the shares are called the real owners, as they have voting rights in the company. That's why preference shares are the people who have the right to receive dividends, and their dividends are also fixed, and they are not varying according to the profit. They have also the right to receive capital at the time of liquidation of the company. But at the same time, they don't have any voting rights of a company, so they are not called the real owners. um, Next is, there are four types of preference shareholders. First, preference shareholders can be classified into convertible and non-convertible. This is based on whether the preference shares are convertible to equity shares or not. Second is redeemable and irredeemable. This is basically whether the preference shares can be allowed for maximum uh, basically irredeemable shares are not allowed in India, and preference shares can be allowed for maximum 20 years, and in case a company is involved in infrastructure projects, then it is for maximum 30 years. After that, you cannot again redeem it. Third is participating versus non-participating. If the shareholder, whether the shareholder can participate in profits apart from the fixed dividends for some extra earning or surplus. Fourth is cumulative and non-cumulative. Like for cumulative preference shareholders, the shareholder receives all the unpaid past dividends which were maybe skipped due to insufficient profit or fund. They receive it all together in a cumulative manner. Okay. Yeah. So third type of shares are bonus issue or scrip or capitalization issue. This is basically free additional share given by the company on any occasion. Fourth is rights issue. This is basically given by the company at a lower price. Maybe to for example, today Reliance might say that it will give a rights share of like for this is given to the already existing shareholders, and for example, Reliance might give say that it will give each existing shareholders, whoever is holding 3 shares, he will they will give 2 shares with respect to those 3 shares, and the 2 shares will be sold at a discounted price. So this is called red share, and you can either buy those shares at a lower price or you can deny that offer, and this declining of this offer is known as renunciation of rights. Fifth is private placement. This is when you are offering your company shares to only a specific group of people, and it is not more than 200, and it is a small group, maximum 200 people. And this is very helpful when you don't want that many regulatory interventions and all that. So fewer hurdles will be there. Last one will be ESOPs, employee stock option plans. These are basically a kind of internal shareholders. They are involved in that same organization and in their day-to-day work itself. And yeah, that is all. Now, um, how does the offering of shares occur in primary market at the starting? For this, two kind of offering is there. First is initial public offering, and second is a follow-on public offering. Initial public offering, IPO, is when at the starting of at first when the company is listed on the primary market, that is called initial public offering. Second will be follow-on public offering, when the company is already listed and it is freshly issuing new shares, then it is called fresh issue. And if it is selling old shares again, so it is called offer for sale. So this is two types of follow-on public offer. So now the process of initial public offering, these 6 steps. First is registering that company on stock market. For this, that company must tell their quantum or size of the IPO, and till date, LIC has had the largest IPO of all time. It is 21,000 crore rupees. Next is selecting a merchant banker. Merchant banker basically gives banking related services, underwriting services, and post and pre-support after IPO. Third will be selecting an underwriter. Now, the function of underwriter is basically, according to SEBI, as per at least 90% of whatever issue size you have given, that must be subscribed after IPO, initial public offering. So, in case of oversubscription or undersubscription, underwriter helps by subscribing to it. Uh, so, this is the help of underwriter. The next step will be different types of draft documents. For listing your company, you need to draft 3 kinds of document. First is red herring prospectus. This is done before the launch of IPO, and basically all kind of information related to a company or organization, each and everything is there in this prospectus. Second is abridged prospectus. This is basically the summary of the red herring prospectus. Third is letter of offer. This is issued when the company is going for a rights issue. Then the second last step will be presenting a roadshow or any kind of advertisement to let people know that you are doing your public offering. No, you are, yeah, you are doing your initial public offering. And the final step will be pricing of the securities. Now, the pricing of your shares can be done in two kinds. Like you can either go for a fixed price issue, like you can just directly declare a set price for your share, or you can go for a book building issue. Now, for book building issue, what happens is you have to set a lower limit and an upper limit of price. The lower limit is known as the floor price, and the upper limit is known as the cap price. These two must have a maximum gap of 20%, not more than that. Now, among this lower limit and upper limit, bidding is done among the interested shareholders, and then the price which has the highest bid is chosen as the price of the shareholder, like price of the share. So this is the whole process of uh, uh, initial public offering. Now next is, our Indian stock market has two sides. One is regulatory side and one will be operation side. Now for regulatory side, the Indian stock market is regulated by SEBI, and this power to SEBI is given by four Indian acts. First is SEBI Act 1992, which actually empowers SEBI with statutory powers to first will be to protect the interest of the investor in securities. Second will be to promote development of securities market, and third will be regulating the securities market. Yeah. So wait a minute. Um, okay, so uh, yeah, let's start again. The SEBI Act 1992. In it, the SEBI has three statutory powers. First will be protecting the interest of the investor and securities. Second is promoting development of the securities market, and third will be regulating the securities market. The second act is Securities Contract Act 1956. This is basically regulates to prevent undesirable transactions in the stock market. Third is Depositories Act 1996. This aims to enable electronic transfer of ownership without physical movements of the securities. Fourth is Prevention of Money Laundering Act 2002. Now this was all related to the regulatory side of the stock market. Now second is the operation side. Operation side basically has seven like um, there are seven things for operation. First is required is the Indian Stock Exchange, which is NSE and BSE. Second are the merchant bankers and underwriters. Third are the regulators. Fourth are the brokers like Zerodha, Upstocks, which actually create accounts of people and help them regulate their accounts and guide them how to do investment in stock markets. Fifth will be accounts like Demat and trading account. A trading account is basically an account in which you um, in which you save some you in which so trading account is basically the account in which you keep your money, and from that money you purchase different shares, and that money is then deducted from that trading account, and then the shares are transferred to your Demat account. And Demat account is opened by the broker, but in the customer's name. So yeah, this is the job of the broker like Grow and Zerodha. Sixth will be the function of depositories, NSDL and CSDL, and seventh will be the function of clearing corporations, NSCCL and ICCL. We will be learning about all this in a more detailed manner in the coming chapters. So I am not touching into these right now. Next is so there are three types of investors in IPO. Like when you are doing your initial public offering, the whole of your 100% of IPO cannot be bought by single kind of investors, and they need to be divided into three types of investors as per rules. First is First are qualified institutional buyers. These have the right to buy maximum 50% of your IPO, and these also include anchored investors who can subscribe to the issue prior to your IPO listing by paying 25% of the payment, and then follow it up by paying the rest 75% within 2 days of closure of the IPO. The second are retail investors. They are maximum allowed 35%, and for each for a single IPO, maximum rupees 2 lakh rupees of investment is allowed. Third one is non-institutional investors. For this, maximum 15% can be allowed for an IPO, and for a single IPO, more than 2 lakh rupees investment is allowed. So these are the three kinds of investors in IPO. Next is, what are applications supported by block account as BAS. ASBAs are basically the system which tackles the issue of oversubscription of an IPO. For example, if you are subscribing for an IPO, then the money remains in your blocked account and it is temporarily blocked till the shares are given to your allotted to you. The money remains blocked, and yeah, this is the process. This basically protects you from oversubscribing to shares more than money you have in your account. So that is what. And also in 2018, SEBI allowed UPI transactions for this. Next is pro rata allotment. Pro rata allotment is basically the system in which each investor is allotted a portion of the share based on their proportionate contribution to the total demand of shares. For example, if demand is more, then according to his contribution to the total demand, they will be allotted a portion of the share. Now there are two rules for listing of IPOs. Like IPO can be listed for maximum of for minimum of 3 working days and maximum of 10 working days for fixed price issue. And for book building issue, it can be open for minimum 3 days and maximum 7 days. And extra 3 days will be there in case the price band is revised. Now, second is what are bulk and trade deal. If the total quantity of shares bought is more than 50% of the listed IPO, then it is called bulk or trade deal. Now, what are block or trade deal? Block trade or deal. If the this is referred when the minimum amount of transaction should be at least 10 crores. And for this kind of deal, there are two windows which are allowed. One in morning from 8:45 a.m. to 9 a.m. and second in the afternoon from 5 p.m. to 2:20 p.m. Also, this order placed should the price of this order placed should not exceed plus 1% of the previous day's closing price. This is a important point. Yeah. Second is no, sir, not second, but next is okay. So next is depository receipts (DRs). This is basically in India, though a listing of IPO is not allowed. Like if your company is already listed in Indian stock market, you cannot list it in a foreign country stock market. Now to resolve this issue, the concept of DRs came into existence. Like uh, Indian government allowed them to convert their shares to depository receipts (DRs), and then they can sell it in the foreign stock market. So basically they can sell their company shares as a DR in the foreign stock market. Now American DRs are used for US financial market. Global DRs are used for everywhere's financial market except USA. Indian DRs were basically introduced in India to allow foreign companies to raise capital in India as a form of DR in the Indian securities market. Next is foreign investment. Now there are two types of foreign investments, and then there is participatory notes also, P notes. First is a foreign direct investment, FDI. This is basically when investment is made into the assets of another country, and this is actually higher in value. And for this, at least 10% of that asset should be bought, and high degree of control is there, and it is a long-term physical asset, and many permissions are required for this. Next is foreign portfolio investments. Much lesser permissions are required for this. It is just done in stock markets, and very low degree of control is there, and it is also again for short term. Now third is P notes. P notes are basically the kind of notes they are for people living outside India, but if they want to invest in Indian market without getting registered by SEBI, then they issue P notes. Okay, next is just a few more concepts are there. This is green shoe option. Now, green shoe option is basically the condition in which it is used during initial public offering to wait a minute. So, a green shoe option is used during initial public offering. This is used to provide stability to the stock price in case the price in case the demand increased. Like if the demand is higher than the assumed initial demand, then it allows the underwriters to issue additional shares, and this is typically up to 15% of the original amount of shares offered, but it is also again at the same price. And if obviously the demand is high, then there's additional shares remain available, and this is called green shoe option. Second is demutualization of stocks. This is when any few member-owned stock exchange can become a shareholder-owned stock exchange. Like earlier we read that something like uh, wait a minute. I think, yeah, private placement, the it is only offering to maximum 200 people. So when it is converted into a shareholder owned stock exchange, then it is called demutualization of stocks. Third is delisting. Delisting would be if any stock would not be listed anymore in the stock market. This can be of two types. One will be compulsory delisting, and another is voluntary delisting. Compulsory is when, due to non-compliance of listing agreements for a minimum of 6 months, then for or any other such factor, the company has to compulsorily delist itself from the stock market. Another is voluntary delist if it wants to, and for this the exit price mechanism is just the reverse of the book building method, and it is used at the price at which shares will be bought from the shareholders. Like at the price the company will buy the shares back from the shareholders. So that is the reverse book building method. Now, yeah, that was all in this video. Thank you.